This is Nightly Business Report with Sue Herrera and Bill Griffin.
Gains erased. Another day of intense selling pushes the Dow and the S&P into negative territory for the year, and the Nasdaq is barely hanging on.
Retail wreck. The sector gets hit hard ahead of the holiday shopping season, even as companies report strong sales.
Pockets of strength. Despite all of the selling, believe it or not, parts of the market are working. Those stories and much more tonight on Nightly Business Report for Tuesday, November 20th.
And good evening, everyone, and welcome. The gains for 2018 are mostly gone. The sell-off in technology has spread to other corners of the market, just about every other corner, in fact. And today, the retail sector took a beating, as did oil. All 30 Dow components ended lower. Traders at the New York Stock Exchange were kept pretty busy, especially after both Goldman Sachs and J.P. Morgan said they expect the economy to slow significantly next year. And that led to a lot of red. The Dow Jones Industrial Average plummeted 551 points to 24,465. The Nasdaq dropped 119, and the S&P 500 declined 48. So with the sharp declines, is the 9-year bull market still intact? Mike Santoli takes a look.
Stocks are walking the line between a bull and bear market. While the S&P 500 in the U.S. is down only slightly for the year, it saw its last record high 2 months ago and is now stuck in its second 10% downturn of the year. Half of all large stocks are down at least 20% from their high. Technical analysts point out that the market's uptrend dating back to early 2016 looks broken. For months, investors have gravitated toward defensive stocks of stable companies that can withstand tougher times. Rallies have been brief, and buying the dips has been unrewarding. The typically strong seasonal trends in November have so far been ignored. The corporate credit market has begun to weaken noticeably. Global equity indexes remain well off their highs. And in recent weeks, the most widely owned and loved growth stocks of technology have been toppled. And yet, for all the anxiety and the damage done, investors are taking some comfort in the fact that the U.S. economy continues to show sturdy growth for now. Nearly all deep or lasting bear markets are accompanied by a recession, and there are few clear signs that one is approaching fast right now. In some respects, the market's tailspin resembles the experience of 2015 and 2016. Back then, weakness in the Chinese economy, an oil crash, credit market stress, they all struck a narrow, tech-focused stock rally in the U.S. A 6-month correction phase accompanied by a corporate profit downturn was the result, with the Federal Reserve managing one rate increase in December 2015 before putting further hikes on hold for a year. This might not be the worst outcome for investors if we did see a repeat, given that the market reset itself at lower valuations back then as the global economy recovered. Then again, the U.S. economic expansion is now another 3 years old. Stocks are more expensive than they were 3 years ago, and the threat of a long trade standoff adds a tough new wrinkle. For Nightly Business Report, I'm Mike Santoli.
So was the mood on the floor of the New York Stock Exchange just as intense as the selling was? Kenny Pocari is the director of the NYSE floor division at O'Neill Securities, and he joins us from the big board tonight. Kenny, welcome back.
Welcome. Nice to be here.
I won't embarrass you by telling everybody how long you've been working on the floor, but suffice it to say, you've seen your share of up markets and down markets. What's the mood on the floor, the sentiment? Is this a short-term blip, or is it the beginning of something? Are we in the beginning stages of a longer-term downtrend?
No, I think the mood has turned suddenly to a little bit of concern, but nobody is yet in that camp that it's going to turn into this protracted kind of downturn that you just referred to. I think what's happening, is that there's certainly a shift. There's certainly this change in psychology. With earnings season, we got kind of weaker forward guidance, which is causing a little bit of concern. We saw the market break down in October when rates spiked to 3.25. Now, what's interesting, rates spiked to 3.25 caused the initial breakdown. 10-year rates are 3.05 now, down from 3.25, yet the market can't seem to get out of its own way.
Right.
Partly because the sell-off in October created a lot of trend line damage, right? So at the 50, the 100, the 200-day moving averages, which are typically long-term supports for technical trading, technical analysis. Those lines were broken. And once those lines were broken, risk management software that controls so much of what asset managers do today, they operate on numbers. And the minute the numbers are breached, the risk management software goes into this overdrive and said, okay, in order to protect the portfolio, you need to raise cash. How do you do that? So you sell stock. And so by selling stock, you raise cash. But then what happens? It starts to build on itself. And when the technical levels are all broken, the market needs to find a new bottom, a foundation. It hasn't found that yet.
All right. Well, we'll keep an eye on it. Kenny, thanks for staying late for us tonight. Appreciate it.
Yep.
Kenny Pocari with O'Neill Securities at the New York Stock Exchange.
The retail sector was hit very hard today, just days before Black Friday. It started with investors focusing on Target's higher costs, sending that stock down 10%. And it continued when Kohl's, Ross Stores, Lowe's, and TJX reported results. Courtney Reagan has more on today's retail wreck.
Just 2 days to go until the doorbuster deals begin at Target, but the retailer's latest earnings report is giving investors some concern. While comparable sales grew more than 5%, analysts expected more. The retailer's digital sales increased nearly 50%, but fulfilling those online orders was expensive and pressured margins.
I think the third quarter numbers for a lot of these retailers, could they represent the high watermark? Because we've certainly come through a time period where we've had a strong consumer, we've had a fashion cycle that's benefited, and in 2019, we're going to be lapping tax reform, wage increases, and we've got labor cost pressures and freight pressures. You have a strong consumer, but each of these companies, there's initiatives in place that don't come for free.
Like Target, Lowe's, and Kohl's margins were also pressured, even though both turned in stronger profit and revenue. Retail CEOs are working to assure the market that the U.S. consumer is still strong going into the holiday season and that the right strategies are in place. On a media call, Target CEO Brian Cornell said, quote, "The consumer is very healthy as we enter the fourth quarter. Unemployment is low, GDP is growing." And when pressed as to whether the consumer is weakening, Cornell said, quote, "We see no change in the consumer environment." On Best Buy's media call, CEO Hubert Joly said, quote, "Everything we are seeing about the consumer is very positive." And, quote, "We are feeling really good about this holiday season." But he continued, because the cycle has been going on for so long, everyone that studied economics knows it can't last forever, and as a result are convincing themselves it's going to end.
We think the consumer is in the best place it's been in a long time. I think what you have to focus on, though, is the fact that gains are beginning to moderate, right? We've heard that from everyone from Amazon all the way down.
We're expecting one of the jolliest holidays really for over a decade now. So, I think that investors are already looking out to next year and saying, can this momentum continue?
With so many concerned the strong retail trend is over, the holiday stakes just got even higher. For Nightly Business Report, I'm Courtney Reagan.
Indeed, the timing of the stock market sell-off could not have come at a worse time for retailers. While some of the shoppers we talked to say they do not plan to cut back on holiday spending, others are thinking twice.
I tried to do basically the same thing I do every holiday. I kind of budget myself and decide exactly what I'm going to do. I know in advance exactly what I'm going to do, so I don't get caught up in volatility. I just do what I plan to do. I make a price, I set it, and that's it.
I don't know other people, but you might think twice about the big things. Maybe not gift for the grandchildren and things like that, but an extra goodie that you might have thought about in September when the market was up so high, you might not think that good today.
Markets up or down doesn't matter. I'll find something to buy no matter what.
Well, one thing people were not buying today was Apple. It was the worst performing stock in the Dow. Shares were off nearly 5% after Goldman Sachs cut its price target for the third time this month. That puts the stock in bear market territory, now down more than 20% from its October 3rd high. And if that's not enough, wait until Dominic Chu shows you the size of the market losses in big cap tech.
For many traders out there, the FANG stocks, Facebook, Amazon, Apple, Netflix, and Google parent company Alphabet have been leadership to the upside, but traders have watched them fall by some of the most to the downside. Each one of these names has fallen by at least 20% from their respective record highs hit earlier this year. And just to put some numbers around those percentage declines, they are staggering. For instance, Amazon and Apple, both of those stocks have fallen by enough to shave off around $264 billion apiece from their market values. And just to put that in perspective, that's like losing an entire Bank of America from one's market cap, just to kind of put it in perspective here. Also, Facebook shares, $250 billion or thereabouts in lost market value. Alphabet, the parent company of Google, has lost around $152 billion since its record highs back on July 27th. And online streaming giant Netflix has lost about $64 billion since its record highs back on June 21st. All told, if you add in all of these market values lost, that means these FANG stocks, Facebook, Amazon, Apple, Netflix, and Google, have lost around $992 billion in market value. Yes, that's right. Almost $1 trillion gone in overall market value. And again, for perspective, that's like losing more than the value of Apple as an entire company just since each company's respective high. For Nightly Business Report, I'm Dominic Chu.
And the Fed is still a concern for investors. And now it appears that the market's expectations about future rate hikes may be changing. Steve Leisman explains.
The decline in the stock market and recent Fed comments have investors thinking that interest rates may not be rising as much next year as they originally thought. While a quarter-point rate hike in December looks priced in, futures markets don't see another rate hike coming until June 2019. It had previously priced in March. Some of that new thinking on the Fed comes from comments made by Fed Chairman Jerome Powell himself. He suggested recently that there were equal risks in going too fast or too slow in hiking rates.
One kind of error is to keep rates too low for too long. The other mistake, and we had plenty of advice to do this, is to raise rates too soon and prematurely terminate an expansion. We haven't done that. But we're at a point now where, where we have to take both of those risks very seriously, and that's why we've been raising rates again quite gradually.
Economist Louis Alexander from Nomura said, quote, Powell's recent comments suggest a dovish shift in the chair's message. And some Fed officials have even openly questioned the December hike. Philly Fed President Patrick Harker said last week, quote, at this point, I'm not convinced the December rate move is the right move, but I need to watch the data over the next few weeks. Now, many Fed officials still seem committed to bringing the funds rate to what they call neutral. That's where it neither stimulates nor slows the economy. The Fed puts that range between 2.5% and 3.5% compared to the current funds rate of between 2 and 2.25%. If the economic data weaken over the next several months, the Fed could stop hiking in the lower end of that range, meaning there isn't much more work for the Fed to do from here when it comes to hiking rates. For Nightly Business Report, I'm Steve Leisman.
So we are 6 weeks into the selling. What are individual investors doing? J.J. Kinahan, Chief Market Strategist at TD Ameritrade, joins us now to talk about that. Good to see you again, J.J.
Always a pleasure, Sue. How are you?
You say you're hearing from people that the question about whether or not we're in a bear market. And are they acting on that suspicion?
No, I think the most amazing thing about this, and you talked about it a little bit at the top of the show, is this has been the most orderly sell-off. And I think what's happened is people are no longer buying the dip, but I think a lot of people who have accumulated stocks like, Apple, Facebook, et cetera, that are a favorite of retail traders, people are still sort of staying with them overall, hoping that there's a little bit of a bounce back because they haven't panicked yet. And the one thing I would say to the retail investors, so many of whom watch you every day, is, if you get to a place where you're uncomfortable, think about partially getting out rather than getting out of all at once or all in at once. And I think that's a mistake people often made. But that said, back to the trading itself, I think that, as Dominic, showed, the VIX is still at not a very high level overall compared to even last month. Last month we got to 28. Right. This month our high's been today we're at a 23. So I think people have a little bit of sort of faith that things will reprice at some point right down here.
We've been watching the bond market as well, and while stock prices have been going down sharply, bond yields have not been going down as much as you might imagine, which suggests that people are, when they get out of the stock market, they're not necessarily going to bonds, they're probably going to cash. What do you make of that?
Yeah, I do think that's part of it, Bill. And I think one of the other things where you're seeing, maybe surprisingly, is people still looking for sort of what they consider safety dividend stocks. And we've seen that in some of the consumer staples, particularly if you look at like a Coke or Pepsi that still have over 3% dividends and people feel are more blue chip sort of steady. You know, normally you would see them, as you say, go to bonds or go to some of the utilities or some of the energy players during times like this. But with what's going on with crude, I think that's scared a lot of people away from that play. So I believe you're right. They're either going to cash or going to what they consider to be more true defensive, and some of the staple stocks which have held up very well compared to the rest of the market recently.
Right. JJ, always we appreciate your perspective. Thanks for joining us.
Thanks for having me, guys.
And we're going to talk more about oil in just a minute. JJ Kinahan. Bill?
All right, time to take a look at some of today's upgrades and downgrades. And we begin with ExxonMobil tonight, which was downgraded to underperform from market perform at Raymond James. The analyst says that Exxon will not benefit necessarily from higher oil prices next year. The firm cites Exxon's ultra-defensive characteristics. The stock fell more than 2.5% today to $76.97. But Raymond James did upgrade fellow energy giant BP to outperform from market perform. The analyst cited that stock's valuation. The firm also pointed to BP's free cash flow and production growth. But the stock fell along with the broader market today to $40.10.
Still ahead, why the oil bears are out in force and nowhere near hibernation. But first, a look at the 2018 performance of all 11 S&P 500 sectors. Late today, the French car maker Renault said Carlos Ghosn will remain as the automaker's chairman and CEO for now, while being detained in Japan. But Renault did appoint a deputy CEO to lead day-to-day operations. As we reported yesterday, Ghosn, who also runs Nissan, was arrested for allegedly misusing company funds.
Well, as we mentioned, oil prices did fall sharply today on the usual suspects: supply concerns and worries about a global economic slowdown. Losses deepened after President Trump today said the U.S. stands by Saudi Arabia after receiving the CIA's report on the killing last month of journalist Jamal Khashoggi.
We're not going to give up hundreds of billions of dollars in orders and let Russia, China, and everybody else have them. It's all about, for me, very simple. It's America first. Saudi Arabia, if we broke with them, I think your oil prices would go through the roof. I've kept them down. They've helped me keep them down. Right now we have low oil prices, or relatively. I'd like to see it go down even lower.
Domestic crude did settle around $53 a barrel today. That is its lowest level since October of last year.
So let's talk more about the decline in oil prices. We're joined by John Kilduff with, again, Capital. Good to see you again, John.
Good evening.
All right, so what's your sense of where we are in the oil cycle? Obviously, we had a big drop today. We've seen the market fall for some time now. Where are we in the cycle?
Well, President Trump has turned out to be the straw that stirs the drink in this market, really, because his administration sort of goaded Saudi Arabia and the Russians to put more oil on the market earlier this year, which they aggressively did ahead of the sanctions that were to be imposed on Iran. There was a clear signal sent from the administration that the Iran oil exports were to go to zero, or as close to that as possible, as quickly as possible. A complete 180 was undertaken back in October, or this, when the sanctions came into effect in early November. And lo and behold, we're losing hardly any Iranian oil, and the Saudis and Russians are now pumping full out, flooding the market. We've tripped into an oversupply situation.
But the expectation is that OPEC is going to vote to cut when they meet this next time around, but yet the prices are still going lower.
Well, the Saudi-U.S. relationship was obviously bought and paid for today. There was concern in the market that the Saudis were going to be unhappy with more sanctions being imposed on the country, potentially even on the Crown Prince Mohammed bin Salman. But obviously this relationship is too big to fail, and we're going to now stay together. And as a result of that, the Saudis are beholden to have to put more oil on the market or keep it on the market and keep these prices low or lower or risk the wrath of President Trump. It's a pretty clear setup here.
So if indeed there's more downside, do you have a sense of how much more to the downside oil could move?
Well, we are going into a peak demand period here. Right. The Northern Hemisphere winter should support things. These low prices should have a stimulative effect on most of the global economies. It's going to help the consumer. One silver lining for consumers going into the holiday season here is that even though the stock portfolios are down, here in New Jersey, you're going to see gasoline down around $2.25 a gallon potentially. So that's going to be a big morale boost. But we're at 53, Sue. I can't see it's going much lower than 48. And maybe there'll be some efforts by OPEC to stabilize things.
We will see. John, thank you as always.
John. Thank you.
John Kilduff with Again Capital.
There is talk of another healthcare tie-up, and that's where we begin tonight's market focus. Pharmacy chain Walgreens and insurance giant Humana are reportedly in preliminary discussions to take equity stakes in each other. According to the Wall Street Journal, the talks are still in the early stages, but obviously both companies face competition from the merger of CVS Health and Aetna. That deal is expected to close just after Thanksgiving. Walgreens fell more than 2% today, while Humana was down 1%. Campbell Soup reported quarterly earnings and revenue that beat estimates. The CEO said that he is starting to see improved demand for its soups and a return to sales growth in its V8 drink unit as well. The company faces a key shareholder vote on the makeup of its board next week. Shares jumped more than 5% today to $40.55. And the trade war between the U.S. and China is increasing costs for medical device maker Medtronic. But the company today was able to report a double-digit increase in earnings for the most recent quarter and maintain its profit forecast for the year. Medtronic shares rose just about 2% today to $92.16.
After the bell, BJ's Wholesale reported an overall revenue miss, even as it grew its same-store sales. The discount warehouse chain did, however, top earnings expectations, and it lifted its outlook for the full year. Shares were initially higher in after hours, but they finished the regular day down 1% to $19.83. And also out after the bell, Foot Locker reported improved margins and earnings that were better than expected. The shoe retailer also grew same-store sales and said it's well-positioned to deliver a strong holiday quarter. Investors liked what they heard, and Foot Locker shares initially jumped in after hours, but they finished the regular day down more than 5% to $46.09.
Coming up, even during big sell-offs, there are pockets of strength, and we'll figure out where they are next.
Amazon has reportedly made a bid for Disney's 22 regional sports networks. Disney is required to divest those networks as part of its nearly $72 billion deal to acquire assets from 21st Century Fox. CNBC says Amazon's bid includes New York-based Yes Network, which broadcasts the New York Yankees games. The retailer faces a lot of competition, however. Apollo Global Management, KKR, the Blackstone Group, Sinclair Broadcast Group, and Tegna are all said to have made first-round bids.
Well, even as selling on Wall Street intensified today, our next guest says he's still finding pockets of strength in this volatile market. Joining us tonight, Cole Smead is Managing Director and Portfolio Manager at Smead Capital Management. Cole, good to see you again. Welcome back.
Good to see you. Thank you.
I'm going to guess that you're not looking to technology just yet, right?
No, we're pretty early on in this, Bill. Where the frustration of the market over the last 6 weeks has been is, like you said, in technology. Using Apple as an example, you talked about the couple price target cuts that just came. What we're dealing on in this mania that we're coming off of in technology is what I'll call death by 1,000 price target cuts. Right. It's going to be torturous. It's probably going to be longer, just like the growth era that we built up to this peak in these names was a pretty elongated period for stocks.
So you're looking to Main Street, and you gave us 3 stock picks that you like, one of which is Discovery, reality television. Why?
Well, it's a great question, Sue. So here I am sitting with you guys. I am an unpaid actor for NBC. And this is a great thing for me because I get to sit here and tell you what I think, but you guys don't pay me. Reality television is very profitable because it's everyday people that come on those shows. You pay Chip and Joanna Gaines to run the show and be the anchors, just like you and Bill are doing, but everyone coming in contact with the show outside of that is free or cheap, and there's no script writers needed for the content. So it's a very low-cost thing, and you can make a lot of money doing that today compared to scripts.
But you also like banking. Bank of America is your pick in this case. But, you know, rates are going up, and I know that that's supposed to be a positive for banks, but they haven't, the stocks themselves have not responded. So why do you like them necessarily?
Well, yeah, to your point, Bill, people are very nervous on the economy. That, you know, are we late stage has been the biggest debate going on the last 3 to 6 months. Warren Buffett has been saying that we're in the 6th inning and the big hitters are coming to the plate. And Jamie Dimon's saying 4% on the 10-year Treasury yield. If we're going where those very smart gentlemen have laid out, the economy is not the thing to worry about. But in the interim, Bank of America is an outlet for fear over the economy, much like the home builders have been. One of the other names I mentioned there was NVR. People are nervous on the economy. I think the bigger risk is that the economy is going to do great and that stock, and also, like you talked about earlier, bond markets do poorly in the same time that stock markets do poorly.
All right. Cole Smead with Smead Capital. Always good to see you. Thanks for your ideas
Thank
tonight.
you so much, guys.
You bet.
Amazon's CEO Jeff Bezos is giving more than $97 million in grants to 24 nonprofit organizations that help homeless families. These are the first donations to come from Bezos' $2 billion Day One Fund. The 24 organizations that were given the award serve communities in 16 states and the capital.
All right, before we go, one final look at the day on Wall Street. They're still looking for a bottom in this market. The Dow fell another 551 points today. The Nasdaq was down 119, and the S&P dropped by 48. The Dow and the S&P now negative for the year.
And it's a holiday-shortened week,
Yes,
so
indeed.
we'll see. Stay tuned. That does it for us tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great evening. Sleep well. We'll see you tomorrow.
Right.